This work is licensed under the Creative Commons Attribution No Derivative Works 3.0 license. This presentation is a result of a class project done in Professor Burke Robinson's class at Stanford University titled Decision Analysis Projects Helping Real Leaders Make Real Decisions. This opportunity to present. This is part of project work that we did last quarter, in the spring quarter, with Professor Burke Robinson. We had to work with a company from beginning to end, help them model a strategy decision, and we had to change. We had to hide the identity of the company because they didn't want this going out. There's a lot of sensitive information in it, but the structure remains the same even after after the changes. So we will be calling them New Media. That's the company we helped, and we're looking at what verticals they should be entering. And this project was done by Mohammed Al-Dawood, Rashmi, and myself. Mohammed is in Saudi Arabia right now, and so he's a PhD student in our department in decision analysis. Rashmi, she's a PhD student in mechanical engineering, and she studies blood flows to help researchers of cardiovascular disease. Lots of differential equations, but that wasn't enough, so she's also doing a PhD minor in MSNE, focusing on decision analysis. And and we have blank sheets of paper, so if you have any thoughts or comments, we'd love to get them from you.
Thanks, Somik.
Sorry, one more thing. This is being recorded, so people who miss it can watch it online.
Okay. Or people are remote. So thanks, Somik. Let me start with the agenda for the day. Basically, I'll just describe the decision situation and a little bit about the company that we helped and why what it is they wanted from us. And then we'll describe...
Join the conference.
So we'll describe the New Media's approach very briefly. But the detail that we wanted most of your feedback on is our approach to modeling the problem, and also some of the interesting and novel mechanics that we will be discussing with you shortly in the next few slides.
Hi, who just joined?
Oh, it's Dan.
Hi, are you also on the WebEx meeting?
I'm trying to get in right now.
Okay.
I think we should go ahead.
Okay.
Yeah, please do. I'll work it out.
Okay, so let's start with the decision situation. New Media is a company in the media and advertising area, and they have exciting, interesting proprietary technology which they install in different locations, like different stores. And they're able to deliver media and advertising content via the technology. So this applies in any store where there's, for example, customers waiting in line, so that there are customers that perhaps don't have anything to do or much to do. So they're able to look for something to do in the meantime, which is, if there's this media technology available, they can then look at the content on the screen, have advertising, and also maybe interact with it with their cell phones. That's also a possibility. So basically, the company sells advertising slots on their technology screen, and they pay the stores where they're located for the real estate to be in those stores. So basically, when we say they're trying to decide which verticals to enter, we mean stores in any kind of segment of the market, like cafes, shopping centers, clinics, elevators, cinemas, banks, anywhere where there's a possibility that customers are waiting in line for service and they're not doing anything in the meantime or not doing much in the meantime. So that's the brief description of the company, and they're a young company, sort of only a few years old, and they're looking to expand into different segments of the market, looking to see which of these different verticals would be most profitable or most valuable for them to enter and be in. Currently, we'll say they're in the shopping center vertical, and keep in mind that we've sort of randomized the order of all these verticals, changed the numbers and so on and so forth. So, with that in mind,
Wait, I have a question.
Yes, please.
Why couldn't they just say, we want to do all verticals?
Well, they're still growing, and so they can't spread themselves too thin just yet. You have to start with one, and try to prove yourself and then expand to the most profitable ones, say in the time frame of the next 3 to 4 years. They really want to be in the verticals that will benefit them the most, help them expand, help them be more profitable, and help them spread their own name as well. So.
And is it a race? Are there others that have similar offerings that are?
There are others, but they're not doing exactly what these people are doing just yet. And once they really gain ground, they feel that these other companies that exist in different forms, not quite in what these people are doing, might come in and try to be direct competitors. But in terms of one-to-one direct competitors, I think someone would agree that they're really trying to push the new envelope here. So a lot of the information that we've distilled for them is also something that they don't want, going out to other people who could use this. So, keeping that in mind, I'll just briefly go over what their sort of current approach was. We call it the SOCOmeter, if you will. It's really a weight and rate approach. For each vertical, or for all the verticals put together, they said, well, we think 4 factors are really very important in trying to rank these verticals in order of, some sort of preference value. So just to go over the factors, we look at scalability of network, demographic appeal to advertisers, traffic, and consumer boredom. In a little bit more detail, what they mean by scalability of the network is really if they were to introduce their technology into a particular store in a given vertical, would they be able to do so pretty easily to many and most other stores in that particular given vertical? Is it easily expandable to all stores, or do you have to kind of customize the technology for each individual location in that vertical, which is not as desirable? So if they could scale it easily, it's great. And demographic appeal to advertisers, well, their thinking is that if a given vertical or segment of the market attracts roughly similar kinds of people, then they could get roughly similar kinds of advertisers, and advertisers would be more willing to advertise with them in that given vertical. So the idea is they'd probably be able to generate more revenue if they had somewhat more homogeneous demographic in that vertical. Traffic is just the number of people that go in and out of the store. So the higher the traffic, the better it is for them, the more people they will reach. Consumer boredom is, again, whether or not in that particular segment, in different stores there are lots of things for people to do already, lots of distractions, or whether they're slightly more new in that the new media can really catch hold of more of the customers and keep their attention so that advertisers will be more willing to advertise with them. So based on this, they would score each vertical, and each factor would have a different weight attached to it. So a weighted average is what the score is, and then they'd rank the verticals this way. So that's one of the main approaches they were using to rank the preference of their verticals, really. But what we did was the decision analysis approach. So in the decision hierarchy, we came up with not just the initial question, which was, what verticals should new media enter, but also a related question, which I'll go into more detail on, is given a particular vertical, a lot of the factors that affect the worth or the value of the vertical really depend on which vertical you choose to enter. So the decision influences a lot of the factors. And one of these factors is a secondary decision, which is what should they charge their advertisers in that particular, if they're advertising in that vertical on their media technology. So that's called a CPM. A CPM is really a little bit of a misnomer. It's a cost per 1,000 impressions, but it's not a cost to the new media company. It's a price they charge their advertisers. It's a price they charge advertisers based on the number of impressions they say they can gather for the advertisers. So that's a really key decision because it affects the revenue stream and therefore affects the value of that particular vertical for them. So that became our focus because that's something that they didn't really have a handle on either. So we decided, since a lot of the uncertainty factors, which I'll describe to you in a little bit, were influenced by which vertical they're supposed to be in, we said, okay, we can model a given vertical. Suppose they chose a vertical, we can say, okay, given that vertical, what's the best CPM to charge? And then based on that, you can then calculate the value of that vertical over a certain time frame. And if you rerun the same sort of analysis over different verticals, then you can compare compare the value of those different verticals and then choose to enter a vertical that is the best for new media. So that's really the current decision. And in terms of future, please.
How do you define impression in this?
Impression is kind of loosely defined as a person looking at a screen. Really, that's how they define it.
You've got the traffic going by, and you
Yes.
assume that everyone, when they're...
Not everyone.
Okay.
Then we'll get to this. So there is an uncertainty built in how many people will look at the screen. So future decisions could be something like, how does one customize, what customization to include for a given vertical if you choose to be in that vertical. And some of the givens were that new media would find customization for a whole segment acceptable, but not so much customizing for each store in that segment. That would be too much effort. We're looking here at whole verticals and not so much an optimization problem of okay, in San Francisco we'll put the technology in this many salons and this many cafes and this many shopping centers and so on and so forth. So this is really trying to judge the value of a given vertical. We start with the shopping center vertical because that's what they're in currently, and we'll show our process for that particular vertical. And basically, new media is going to continue with their existing business model of renting real estate space, that is renting from putting up their technology under their own name in these stores, rather than going and saying maybe doing deals with big chain stores like McDonald's and putting their technology but under the McDonald's brand name. So that's not something they're doing right now or they're interested in doing. They're going to do it under their own name. So that's the given. Given this decision hierarchy, I'll take you through our original decision diagram, which we simplified considerably as you'll see it towards the middle of the presentation. Our original decision diagram, we have, of course, value being revenue minus cost. And on the cost side, it's something that they had characterized pretty well. We have one-time costs and recurring costs over a certain time frame. One-time costs being the cost of actually acquiring the real estate space. And there's technology cost, the cost of the technology that they put in there. Recurring costs being a given cost per venue, which is really from maintenance, rental cost, and another sort of technology cost up here. And there's sales force cost, and a certain number of venues that they target to acquire over a period of time. So that's really the cost side of the equation. But the revenue side is what we spent most of our time on, and it's the one that was most difficult to characterize and structure. So the revenue side, really, the revenue calculation is made up of 4 different factors, which I'll describe to you very soon. Utilization, CPM, which you already heard, number of impressions, and a discount factor. So utilization is one of the most important things that they need to be aware of. That's utilization is really the percentage of, utilization is really the percentage of advertising slots that they have that they can sell. So it's a percentage that they're able to sell of the total number of slots that they have. So, and the number of impressions is the number of people number of people that they're able to get to look at their screen. A discount is just some sort of negotiation discount factor that they may or may not provide advertisers. So it's uncertain depending on who the advertiser is. So utilization really is then relevant to many factors. The CPM influences utilization, so the higher they charge their advertisers, maybe the utilization will go down. The lower the CPM, the utilization might go up. The other 3 factors are quite interesting. That demographic homogeneity is the same thing as what I described to you as demographic appeal to advertisers. The more homogeneous the demographic, the more utilization you might have. Quality of engagement, which is really something that you can relate to as recall rate, which is kind of the percentage of people who look at the screen, who happen to walk out of the store, and if you happen to ask them, do you remember what you saw? Is the percentage of people that would actually recall what they saw. So that's related to this quality of engagement metric that they tried to use. And percent of venues in the market, the idea behind this is, suppose you're starting out in a new vertical. only happen to acquire 10 out of 1,000 venues, you may not get that many advertisers to advertise in those locations. But if you happen to acquire 200 out of 1,000, then suddenly your utilization is different. So that's the idea behind that. And quality of engagement is again related to what they classified as consumer boredom. And the more time you spend in queue, the more likely it is that the consumers are engaged and that they recall what they saw. So that's the idea behind that. Going back to number of impressions, and let me do that first. With the percentage of venues in the market, it really depends, of course, on the number of venues that you can acquire per month. And if you notice, this particular uncertainty is there both in the cost side and the revenue side, and that's pretty interesting. With the number of impressions, here's where the question that you just asked comes into play. We have what's called a notice rate, which is really the percentage of people that come to the store who look at the screen, slightly different from the recall rate. So the notice rate is something that's quite important to consider, especially since the number of impressions is the way they choose to characterize the revenue stream, right? That's very important in the calculation. Number of impression also then is related to the traffic that comes into the store, and therefore the number of venues that you have acquired. Any questions? So the whole decision diagram took a while to fit it into one slide, and we did a tornado analysis using this. Please.
Was the whole team Indian?
No.
Because the flow's mostly right and left.
That's
I've noticed that on a number of recent slides that I got from India. Because you drive on the left side of the road.
The last team member is from South America.
Oh, do they drive on the left side of the road?
But they definitely
Oh, no, but they're right.
They write
Oh, right and left. Oh.
So I have a question just for
Please.
clarification.
Yes.
Your utilization,
Yes.
it looks like it's both a measure of how many slots are being used and also the kind of quality of the message, the quality of the communication. This recall rate is a measure of how.
It's thought to be relevant to everything, relevant to the recall rate, and if that's because the idea is if you place your technology in a location where there aren't going to be that many people, or things are moving very fast, and then people just don't have time to look at the screen, then advertisers won't really want to advertise with you. So it's really a measure of how advertisers view where their screen is placed. So if their customers, which are the advertisers, view it favorably, then they would buy more slots.
You gotta put this where there are DMV lines. People have to wait a long time to get in.
We had post office in there, not the.
Yeah,
Post
post
office,
office,
yeah,
banks, and anywhere where there's long lines. DMV's a good one.
Okay.
So we did a tornado analysis on this, and we based on that we simplified some more, and I'll just take you through some of the main results of the tornado analysis. The interesting thing is the stuff highlighted in green really accounts for 98% of the variance in the model, and that really, all of these things, they're in randomized order, but they're all from the revenue side. So the revenue side of the equation captures most of the uncertainty in the problem. The cost side is something they had already spent a lot of time on, and they had gotten it pretty tight and pretty well resolved. So that's something that had low uncertainty associated with it. And if you think about it, going back to the SOCO meter, the four factors that they had, the one that really remained was the quantitative traffic. Everything else, we were able to subsume into other uncertainties and based on many assumptions. So we had to, in order to make the problem tractable as well, we said that new media was pretty good based on our discussions with them. They were pretty good at optimizing, given a particular vertical and set of parameters. They were pretty good at optimizing so that the recall rate that they would get would be high. So they were pretty good at optimizing the content they would put, the placement of everything, and also being able to choose advertisers, match advertisers to locations, match what to show at what time of day. All of those things are something that they do pretty well. So we were able to say that those are givens, that they would initially at least choose locations and situations where they would get high recall rate, and where they would have and those verticals where they would be able to scale their technology pretty well, rather than choose something that required high degree of individual customization. So this is a little more focused on those things that they could do really well, and then just resolving those uncertainties that they couldn't do before.
I have a question.
Yeah.
The tornado is very symmetric. I was wondering, how did you get the input from the company?
Yeah.
Is it something, did you estimate, or did you have a group of people that you worked with at the company?
No, so these are all the numbers of the company, and so we initially we had a hard time getting them to accept what we were doing, so we had to first match their baseline calculation, so with the deterministic. So when those numbers matched, then they said, okay, we can trust what you're doing.
And in fact, the symmetry that you see is really, it wasn't intended that way. It just came out from all the numbers that they decided to put in as the low end, low end and the high end. So based on this, we actually decided in our final decision diagram that we would, on the cost side, we would just include the base cost values because the uncertainty in that is so low. On the revenue side, we have three independent uncertainties: the notice rate, the traffic, and the number of venues that they could acquire. And of course, the utilization, which is influenced by the CPM, percent of venues in the market, and the traffic. So this is the final decision diagram that we worked with, and with that I will hand over to Somik to give you the brief results and the interesting mechanics.
So we found that the best CPM they should charge is $44, and they should pay more than $1.5 million to obtain information on traffic per day, pay no more than $60 million to keep traffic at the high level, pay no more than $27 million to improve notice rate to the high level, and pay no more than $25 million to improve number of acquired venues per month. And the value of the entire vertical is about $54 million. So they were pretty shocked to get this kind of information, because they knew notice rate was important, but they didn't have any mechanism to figure out how important and how to do budgeting on activities that could improve the value of their business. And going a little deeper into how we found the optimal CPM, so I'll be unpacking this some more, but basically we came up with this curve which shows that if you charge below $18, it doesn't make sense. If you charge above 80, it doesn't make sense. If you charge too little, you get a lot more people, but you won't be making that much money. If you charge too much, you will make more money, but not enough people will come. So there's a sweet spot there, which is $44. And there's a 75% chance that you'll make money in this vertical, but that means a 25% chance of losing money, and a 25% chance of making above $150 million. So 50% chances between 0 and 150 million. And this, so we basically shared with them, this is the result of 6,075 what-if analyses, and this one is 243 what-ifs. And there isn't much difference in the green and the blue lines, risk neutral and risk tolerance at their level. And the impacts of controlling the uncertainties, the upside improves the most for high acquired venues. So if you acquire more venues, there's a chance that you will actually make a lot of money that shifts to the right most. But the downside improves the most for high traffic, and that's this line here, the magenta colored. And that sort of makes sense, because even if you don't have that many venues, if you have a lot of traffic, then at least what you're spending, you're making more than what you put in. And it's the worst for high acquired venues. So there could be a possibility that you have a lot of venues but not enough traffic, and you're losing money on rental costs and everything. So this graph was also very communicative when we showed it to them. And then we compared the beliefs of the chief financial officer and the chief network officer to see if there was any major difference. And we did this through a sensitivity analysis on risk tolerance, and they're actually somewhere down here. That's something we struggled with because they're a startup company. So we use the standard mechanisms of 1/6 of annual revenues, which is too little, and 1/10 of equity, which is again too little, but somewhere around here. But as you can see, they didn't differ that much in the decisions of the CPM. They were pretty much the same. And the value of information and value of control numbers were also very, very similar. So this gave them some amount of confidence that they were on the same page, though the chief network officer was a little more conservative than the chief financial officer, which also came out in their personality. The CFO was far more optimistic about the company, and the CNO was the guy who was implementing it, so he would give lower estimates. So the conclusion of the analysis was that the vertical was worth $54 million. And we could repeat this process. We gave them a very clearly defined process for each vertical. We were able to do that because the structure of the problem remains the same, more or less the same for different verticals. And this is where we get into the mechanics behind this. And so we did 3 assessments of the 3 major uncertainties: the notice rate, traffic, and the acquired number of venues using the probability wheel. It took some time, but we were able to then discretize it and use it in our assessments. But the real interesting part was in assessing the conditional distributions on utilization. And this was the part of the decision diagram you saw earlier. So you had the decision on the CPM, the number of venues, the percentage of venues that you've acquired in the market, and the traffic. So if you start with the percent of venues in the market, let's say it's above the threshold, and let's say you have high traffic, then there were 3 levels, discrete levels of the CPM that they could choose. And let's say it ranged from $32 to $72. And we would pick one, the middle one, as the base, and we did a conditional assessment using the probability wheel. Then we matched it with the nearest possible beta distribution, which they were comfortable with. They said, okay, this is fine. And then we assessed the distributions for this and this leaf. So we said, well, if you drop the CPM to $32, then utilization will increase. So that's the red distribution here. And if you increase the CPM to $72, the utilization will drop because you increase the price now. That's this distribution. And so we did this for all of the leaf nodes in this tree, and we got all these distributions. And then we started noticing that when they were assessing this, they were actually shifting the mean and the variance of the beta distribution, and the mean would drop linearly. So we decided to make that assumption that if for 2 given distinctions, 2 given degrees of these distinctions, the CPM drops linearly in its so the utilization drops linearly in its mean in response to CPM, and the variance has a quadratic relationship. And this is because they feel there's more uncertainty in the middle, but if you increase the CPM or you decrease the CPM, they're more sure that the utilization will either increase or decrease. So we were able to find functions that gave us the endpoint assessments that matched their assessments, and then we made the assumption that we could use this to model continuously. So you give an input value of the CPM and out comes this distribution. So we did that for all 3 values. And from that, you can easily generate the beta distribution and discretize it. So in effect, this became a continuous range with these assumptions. And this is what let us plot the continuous plot on this. You'll notice that the optimal CPM was not the discretized level that we picked. So this is our fundamental move in this mechanics. So, and based on this, we were able to find the value of the vertical. Yes.
So back when you're showing the value of perfect information, what was the decision that you're affecting with that information?
Yeah, we removed those slides.
But the change in the CPM was quite small, maybe $1 or $2.
If the CPM level changes, then that would be the main decision that you're affecting.
Maybe I'm not making this up, but several slides ago, you there's a statement saying the value of, don't pay more than $1.5 million to obtain information on traffic per day.
Yeah,
That's the value of information
yes,
statement.
yes,
What's the decision that you're affecting? Is it
The CPM charge.
yeah.
the CPM charge?
Yes, that's the only decision in
It's
this
the whole
model.
thing.
So do you charge $44 or do you charge?
So you're
40?
saying if you paid more than 1.5 million, yeah, you could not change the CPM to make that.
Enough to make it.
Yeah.
Yeah.
Bring the
make-
curve
yeah.
down.
Right.
Yeah.
So you're saying because the value as it's affected by CPM is kind of shallow,
Yeah.
you can't use information. for
But since CPM is almost of a continuous variable, this value of information calculation is not a simple one.
Yeah, it's not, yeah. It takes a while to run.
Yes.
Yes. For any analysis, it takes at least 15 minutes
The
to run.
active, you have many choices.
Right.
Yes, that's good.
Yes.
Okay, all right, thank you.
But we did increment by,
A
I think it
certain
was $1
amount,
or
Yeah,
something like
$1
that, so.
increments.
There's one thing that we started discussing yesterday, and I think it might be good to open it up for everyone. So one question I had yesterday was, because I got a preview of this presentation. I got lucky yesterday, I got a preview. So one thing we discussed was, is it possible to sort of challenge the sort of business model that they're thinking about and say, you know, if you look at this whole vertical, it's an awful amount of money given their size, right? It's a very big deal for that sort of a company. So we were trying to think yesterday of, is there a way that they can transfer risk to someone else? Because, you know, this is such a big deal, maybe they want to transfer some of the risk to someone else. So one of the possibilities we were wondering about yesterday was, what about saying to the people whose space you're going to be renting, instead of paying you a fixed rent, I'm going to pay you a fixed rent plus a variable rent. So the fixed rent is going to be lower than I would otherwise, and the variable will depend on how successful my advertising campaign is, you know, in shopping centers in San Francisco this year. You know, so you're sort of sharing some of the rewards with the people.
That's done a lot in space. So almost all leases at shopping centers, for example,
Okay.
are based on the revenue that is going through with some minimums. And so this kind of a pricing structure might be
So that,
interesting.
yeah, that might be a question you could ask them.
And that would affect the acquired number of venues. And that's one
Yeah.
of the big
Exactly.
ones we're interested in,
I mean,
right?
it can affect almost anything in your background.
True.
You're completely changing the way you're doing business.
The
right?
structure will change.
Yeah.
Risk share.
So it's just that sometimes when you look at deals like this, which are so big compared to the size of the company, of course the company is growing, so 2 years from now, hopefully it won't look like such a big deal anymore. But right now it looks really big, so perhaps having sort of a risk transfer
So-
mechanism.
It
So
might
it's
encourage-
it's only big when you think your decision is to either go into the vertical or not at all, right? But in fact, penetrating the vertical is one site at a time, okay?
And we take that into account, well, somewhat.
Well, but you could stop at any time.
Yeah,
you
So
can
it's
stop
not-
at any time.
That's
It's
true.
really not that big of a deal,
Yeah.
because your uncertainties are going to reduce systematically because it's a sequential decision process. So you set up and saying, okay, we're gonna go hire 2 people, and those people are gonna open this up, and then we're gonna, and while we're doing that, we're collecting data as we're learning what the actual traffic and what the actual is.
Yeah, that's a good idea. You could have pilot sites. Like you could have pilot shopping centers in San Francisco. Like they were speaking about the value
They
of,
actually do that. They,
Okay.
at least in the first instance, I believe they did a
And
pilot
it's,
thing.
you can stop at any time with the vertical.
Yeah.
Any of these kinds of things, what really happens is that it's a sequential decision process. So you say, we're going to go into this, and you did the value of what we today believe if we go for the full vertical. Okay?
Yeah.
And now, if you escalate this a little bit and say, you're going to have other vertical ideas and new variations on the theme as you're rolling this out. So it's not as, it's,
No,
it's
we,
not a,
we
it's
model the
not
time
this-
frame of 3 years as a solid block.
Right, you-
Saying
that's
they
how you
commit to
model
3
it.
years or not.
And so this will be like a portfolio of movable parts that each can expand and contract
Yeah.
at the next level of the decision problem. But it's a nice piece of work for a class. How much time did you put into it?
Towards the end, it was quite a bit.
How much is quite a bit?
We
How
were
many
supposed-
person years?
Well, we had budgeted 5 hours a week, but I think we ended up putting in 20
like
hours.
15 to 20 hours per person per week.
For 3 people?
For 3
Yeah,
people.
sometimes they would be together, so we
Okay,
have
so
3.
3 people, about, what, so 60 hours a week for how many weeks?
For at least 6
For
weeks.
at least the last 5 weeks. We,
Yeah,
5 weeks?
5 to 6 weeks.
For the first 5 weeks, we managed to do maybe 5 to 10 hours
Okay,
Yeah.
for each person. So
so 6 times 60? 60 hours? Divided by 40? Okay, that's about, let's call it a 10-week effort,
Yeah.
full-time effort, equivalent. Nicely done. Very nicely done. That's it.
Any
Yeah.
other comments? We were not sure about this whole period distribution thing, making these assumptions to do the continuous analysis. Does that,
But you gave a bit of this distribution discussion not too long ago. I don't think this is where your issues would be. I think if you wanted to improve on that, it isn't likely around how you characterize the uncertainty and whether it's continuous or discontinuous and so on. It's much more this, this is a locked-in 3-year SEF, okay? And so if you wanted to model that more, you would break this up into, you're going to get most of this value of information just by your normal business plan, right? So your value of information calculations are on what if we were locked into doing this, even though it was a dumb thing to do after 3 months when we saw the results. That's not the true value of information, right? It's much more in this is a dynamic decision problem that's sequential, where you have a learning, and if you modeled it that way, which is not, it adds a lot of complexity to it. But you probably could do it once you had that influence diagram so simple. You could at least say, let's do this in 6 months increments, or for the 3 years, and we have decisions to get out or stop based on what we learn. We want to look at the learning rate. How fast will you know more? How fast will this uncertainty that you currently have get reduced? And how will that then affect your decisions? And that's information you get without having to go for value perfect information, right?
It's also a trade-off in a way, because if you're starting to get afraid about the competition getting in faster than you, like you could make a trade-off between how much information you want to get and how much certainty you want to have about the market, and how much of a risk you're willing to run on in terms of losing your market. So you could have almost like a full set of strategies going from like, we're going for the whole thing right away at the beginning, to we're really taking as much time as we can before we commit to any vertical at any point in time, and you have lots of in-betweens.
probes and things that you can do?
Yeah, like,
You see these things cropping up in all the elevators in
Yeah.
big high-rises.
Yeah.
And they
Walmart.
sprinkle a little noose in between, and then it's an advertisement. So, and they have a captive audience. You got a full elevator. It's
Walmart has put them up now, their checkout units.
at the checkout counters. Yeah. Interesting.
it's a good business.
Yeah.
So you had mentioned initially that there's some user interface also in the way advertisements are displayed, right?
Not so much in the way the advertisements are displayed. Currently, it's more like the ads are displayed. Say it's more like an ad for a movie, or something, and then it'll have maybe something that says if you text this number, then it can return back, whoever it is controlling that thing can return back to you in your 5-block radius or something with, is there a movie theater showing that movie and what times those movies might be shown. So it's not quite completely interactive just yet, but it is in a pseudo-interactive fashion. You could get information like that. They're starting to build that in. So
Yeah,
that's pretty useful.
Yeah, because if it allowed user to kind of click on those ads, and you could also use things like cost per click, which probably may be more concrete than cost per
They
impression.
can't quite do the individual user clicking on the ad, but certainly they can have the whole text message code thing. Maybe if you say, text this code to a website, or go to a website and look this up, and maybe you'll get a coupon for a sale, or maybe you'll find out where the best price for a particular item is in your area. So that's the sort of thing that they're working on.
Thank you so much.
Thank you for this
Thank you.
opportunity. It's really good.